Good afternoon, everyone. Today is Friday, the 25th rather, of November 2011. This is Brian Shannon speaking. Let's take a look at these markets. Hell of a rough week for stocks. We'll take a look at the numbers first. Let's find that. You can see here the S&P 500 was down 4.5%. Russell 2000 was down 7.5%, as was the semiconductors. So big percentage losses this week, 5.7% for the financials, and there's no sign really of slowing down for these markets either. That is, we're not finding any support. We still have this. We're looking at a 10-minute time frame, a real solid pattern of lower highs and lower lows. So the downtrend continues. We closed right on the lows here today, and in fact, there was pretty strong selling right at the close. So once we gave up that volume weighted average price in here today, we had a series of lower highs that were showing an increased pressure on the market, and then we broke that volume weighted average price, and it dropped almost a point from there. So again, there's no sign of any support in here. Next week we're going to want to see the market get at least back above this about 117.70 level, and we've still got the declining 5-day moving average. Now we do sometimes see good rallies come as maybe a market gaps up above that, but there's nothing indicating that in any of these time frames that we have anything bullish going on here. Let's take a look at that 65-minute time frame. We've been observing these Fibonacci levels, that is the retracement of what was basically October range, that is that large that low down here, up to the highs in October. So we've been coming down first at 38.2% level, and we broke that obviously this week. That's where the real damage came from. Was when we gapped down on Monday, and now we've seen the market try to stabilize above that 50% retracement level, and that of course failed with the gap lower yesterday, or Wednesday I guess. And now here we are, maybe going to try to find some support at that 115.75 ish level. We know that we'd been keeping an eye on this. This pattern here, the symmetrical triangle, that is, and what we want to do is you want to take the height of that pattern. So the height of that pattern, really, we can call it about 129 down to 120 22. We'll just to make it even. So about 7 points. So we take a look at that point where it broke down from at 124 and subtract 7 points from that, and that would give us basically 117. So this is where the symmetrical triangle is supposed to stop. That is, the selling is supposed to stop. But of course, we're not showing any signs of support in here, so we have to remain defensive and wait for the real evidence that the market is flattening out, and that we get more than one or two sideways days. That we, first we have to, we're correcting through price. Then we're going to need a little bit of time correction, and then perhaps begin to move higher. But this daily chart is really severely damaged as well. So we're in this kind of you look at the weekly chart, it's looking like, because we broke back below this important level here, we're getting a failure, and perhaps we see a test of the lows. We're supposed to be in a seasonally bullish time of year, but of course, those are just guidelines. They're not anything to trade off of. Let's take a look at the Nasdaq. That of course had a bad week as well. This market had been holding up much better than the rest of the markets, as it was trying to challenge that multi-year high, about a 10-year high, up near that 60 level. But of course, we lost an important support area at that $56 level last week, and then this week we continued to see further weakness as it gapped down, and we remain in this pattern of lower highs and lower lows below that declining 5-day moving average. So it's guilty till proven innocent. And looking at these Fibonacci levels are also it's important to point out that they're guidelines. They're just something to look at, like any type of potential support, like a moving average. We look at that level, and then we say, okay, there's the potential area that this market may stabilize, and here being the 61.8%, that's where it might stabilize. But what we want to do is be aware of that level, that $53.60 level, and then look to shorter term timeframes and say, is there any support actually being found at that $53 and what was it, 60 cent level? And the answer is no, there wasn't support being found in there. So until the support is found and the market begins to break that pattern of lower highs and lower lows, they're good levels to be aware of, but they're not something to trade blindly off. Nothing technical really is something to trade blindly off of. They're just tools to give us reference points, and in this case, this reference point has basically been destroyed as the selling has persisted. And you look in here, there's nothing really traditionally in here either that would make it look like perhaps we're going to see any type of uh, bounce or support found. So we just have to maintain that defensive posture, and perhaps we're going back down to 50 again. Until the market stabilizes and tells us it is that it's ready to turn back up, then we have to look at it as guilty till proven innocent. As we said, the Russell lost, I think, 7.5% this week, and of course, it started out like the rest of the markets with selling right on the open on Monday. We were already below a declining 5-day moving average, and of course, the same Fibonacci levels in here, we can see that, the Russell has been, it accelerated to the downside this week, and it's really playing more catch up to the other markets. As you can see, we're right at that now, that 61.8% retracement. Is that going to be the level that this market finds support at? Well, when you look at a shorter term time frame, it's saying there's nothing here indicating that there's any support being found. We closed right on the lows, so selling continued right into the bell. So this is a level to be aware of, but obviously not an action point. Next week we'll probably see that if we get a bounce, that this will become the resistant, the bigger resistance level near about 68.5 or so. But again, where is potential support? Is it down here? Trying to blindly pick a support spot, and not blindly, but an educated guess at where support might be found is what we want to do. But there's really nothing on these charts indicating where that level might be found. Perhaps it's going to be down near this 65 level where we spent a lot of time probing in August and September, and from that failed breakdown here as well. So perhaps we're going to continue down towards 64 and a half, 65, but there's no sign of support yet. So don't be early to be looking for those buying opportunities. We had big support lost at this 30 and a half level in the semiconductors this week. That was obviously the prior support as well as the location of that 50-day moving average. And in there, what we saw was, of course, a gap lower, and then just this real persistent and consistent pattern of lower highs and lower lows, closing right at the low end in here as well. If we take a look at the Fibonacci on the semiconductors, we can see that that this market is also gone beyond that 61.8% retracement. So there is no support there, basically, at least not yet. Maybe we'll begin to stabilize in there next week, or perhaps we're going to continue to on towards about 27 and a half. That could be the level. But again, it's guilty till proven innocent. That's the main point, that the support levels are not revealing themselves in any of these markets. The financials obviously were a big loser this week as well. They broke that the important level of support that was found in there at $12.80 a week and a half ago, and from there we've just seen a real persistent pattern of lower highs and lower lows. It's the same. I mean, it's the same for all these markets, obviously. And you look at the Fibonacci in here; it's been pretty much useless. We've observed them as reference points, and it appeared maybe the market was going to try to stabilize at the 50 or the 61.8% retracement. But when we still have those declining 5-day moving averages and the lower highs and lower lows below it, being aware of a Fibonacci level is pretty much useless. So the markets continue to remain vulnerable here to all the global uncertainty, and it's being reflected in price. So hope you traded it well, and talk to you next week. Thanks.